Hi, this is Chuck Oliver. Welcome to this week's Hidden Wealth Solution Review. Well, I want to talk to you about the two greatest threats for taxes in retirement. Now, I'm not just talking to you, the retirees, I'm also talking to you pre-retirees, and lean in and listen because I want to get this book in your hand, The New Holistic Retirement, that's going to address these two greatest threats to taxes for your retirement. And these were proposals by being fortunate to work with a tax team of CPAs that are tax planners, high income, but low taxes. And that's what you want. You want people that are saving taxes using the tax system themselves to the fullest, and that's what our clients are missing, and this is how they can avoid it. See, one of the articles I talk about on Taxes Saved Radio this past weekend, which you can find all of our radio programs archived on your favorite radio streaming apps, right, under Taxes Saved Podcast, is I talk about the case study, and I'm going to talk to you about this case study quickly, of a gentleman that wishes he would have had more control over the output, because the article out of Kiplinger talked about really the thing we should key in on is controlling our input, right? One of those inputs is where are we saving and what is the treatment of where we're saving? So in other words, if we're tax deferring, we're deferring our tax, but we're also deferring our tax calculation. And the government knows this, and they're having a heyday on clients like this because, get this, this gentleman's required minimum distribution this year at age 83 is over $800,000. And he came to us saying, look, and go to taxessave.com, folks, because I'm going to teach you a 20-minute webinar on a couple of the strategies this gentleman's initiating, and is going to be able to save a mountain of taxes from his two adult retired sons, right? Because this gentleman's already almost in his mid-80s, and his adult sons are retiring or have just retired. And the sons don't want a big tax burden, but the dad doesn't want the tax burden while he's living, and he surely doesn't want to leave a monster tax burden when he's leaving, right? Living and leaving, folks, you can control both ends of that, but it's how you can control the input. Don't let the government control your output. So here's the two threats. The restriction of doing Roth conversions, which was once a thing prior to 2010 before the Obama administration lifted not having to have an earned income, so retirees couldn't do a Roth conversion unless you had earned income. And for those that had too high of a reported earned income that were working, you couldn't do Roth conversion, just like today you can't do Roth contribution. That's number one. That was proposed, and you got a lot of people that were really hoping that was going to go through. But of course, thank the Lord above that administration didn't continue on, or anyone around that administration, with those thoughts and beliefs. And look at what's still happening, right? The threat is very real. The debt isn't coming down. The debt is going up and ballooning. The interest on our debt is going to exceed over $1 trillion. Our deficit spending is on target to be somewhere between 1.2 and 1.8 trillion on an average, over 22 trillion of deficit spending being added just because of how high our debt is with some of our interest in the inflation of our debt. Now think about that. The second one is called the any age required distribution. So unlike this gentleman who's 83, who's had to be taking our required distribution since he was basically in his early 70s, 70 and a half, it's the any age RMD. And this is penalizing people that have saved too well and have grown their money too well, on penalizing you on the output. Because what the proposal was, if you're, let's just say the government mandate was, if your balances exceeded in your IRAs and Roth IRAs over 2 million the prior calendar year, right, wherever that ended, and let's say your balance is at 3 million, then you're over that threshold by $1 million. You have to take out what was being proposed. It's not law, it was proposed, 50% of the excess that you exceeded the threshold. So not only do you have to take that out of Roth IRA or IRA, you have to take it out of Roth IRA. And they thought so far ahead that they said, no, we're not going to let people cheat and just take that forced any age. You don't have to be 73 or 75. Any age, right? You can't just take it out of Roth when you're still making a lot of money and having to report a lot of taxes. So that way you could have kept your taxes down. You have to take it proportionate to how much was in the Roth versus the regular IRA and take out that excess of 50% penalty. Folks, don't wait around. You've got primaries out there electing communists that are supporting government-ran grocery stores. How well did that work in the Soviet Union? And you still got some lunatics out there. Protect yourself, folks. Go to taxessave.com. That's taxessave.com. Learn how this gentleman used a strategy, actually two strategies, to create deductions that offset a game plan going forward of preventing his IRA being an IOU to the IRS. as we like to say, right? He was able to drastically reduce his RMDs, majorly protect his sons from major inherited required distributions, in saving a fortune. But here's the last thing I'll leave with you. He didn't realize how exposed his estate was, because as he keeps growing this money, and he's growing it darn well, if he's amassed 15 million, he's done a great job over that period of time. And all of a sudden, if that becomes 30 million and the threshold for estate tax is exempted only, let's say, up to 15 million with what Trump's proposed, he's going to end up at some point having somewhere around 15 million exposed that can't be hidden from estate taxes or avoiding state taxes. And that's going to generate at a 40% tax rate, as the law is today, another 6 million of unnecessary taxes to his estate that his adult sons are not going to get. Folks, you work hard for your money. TaxesSaved.com. That's TaxesSaved.com. I hope you attend. I want to gift you the book for registering, attending. It's a quick on-demand webinar. You go right to TaxesSaved.com, click the red square with the white arrow in it, click it, put in quick information, watch it on demand on your terms, and look at the case studies and learn those, and then request a saving tax optimization plan to learn the tax risk road you're on and how you can maneuver so that you not only can control your input, but you also can protect your output. TaxesSaved.com, TaxesSaved.com.